Everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. Given the recent sell-off in the stock market, investors have been thrown into a frenzy, and there is a tendency for many to lose their hard-earned money. In this unstable stock market situation, it'll be great to revisit some key principles that guide us in investing. It's the right time to regain in-depth knowledge of market fundamentals. Knowledge, they say, is power. So today, we'll be looking at our top 3 takeaways from the book Intelligent Investor by Benjamin Graham. Known as the father of value investing, Graham presents the strategies that will change your investing game and make you successful. Let's dive in. Takeaway 1. Mr. Market is a manic-depressive person. Dearest Mr. Market, think of him as a partner in a private company whose actions you can't predict. If you want to be an intelligent investor, then do away with the thought that you can predict Mr. Market, because you just can't. He's like a merchant who brings goods to you every day, and his offers are either to buy or sell stocks to you. However, just like humans have moods, so does Mr. Market as well. When depressed, he offers to sell his shares to you at a price below the real business value. But not long after, when he is in a manic episode, he offers to buy your shares for a very high price, which is above the business's intrinsic value. So, you see, there is no way to know what mood Mr. Market will be in, which is why you need to protect your capital against Mr. Market's unpredictability at all costs. Now, when we're referring to the intrinsic value of a company, it's the worth of a particular stock based on how much a company makes on its assets and other factors. In other words, intrinsic value is used to determine if a stock is over or undervalued in the market. Intelligent investors who use this concept will look for an opportunity to buy a stock whose intrinsic value is greater than the market price, because that means that the stock is undervalued. So, as an investor, you should expect Mr. Market to give you wild offers that differ on different days. Some days it can be 10% higher or 50% lower than the intrinsic value. Takeaway 2. Always have a margin of safety. What is the margin of safety? Another key concept that we learned from Graham is the margin of safety, which is essential to increasing your probability of success. Remember our explanation of the intrinsic value and how, as an intelligent investor, we should only look to buy a stock whose price is less than the intrinsic value? Yes, that process enables us to have a margin of safety that greatly limits our losses. Therefore, for an investor, the margin of safety is simply the difference between the stock market's price and its intrinsic value. Why must we have it? Every investor needs to have a margin of safety because it serves as a risk management strategy. Once you understand this concept, you can safely analyze and plan out your investments and decide if you will go ahead with your plan or not. When you learn and adapt to this concept from Graham, you'll be able to stay away from companies that have huge debt, which can affect your investments in the future. What happens if you don't have a margin of safety? If, as an investor, you don't have a margin of safety, you could suffer a great loss when the market is unfavorable. Takeaway 3. Investment and speculation. Every investor should keep investment and speculation separate because they are different entities. The Graham definition of investment says that an investment is one which, upon thorough analysis, promises safety of principal and an adequate return, while he categorizes speculation as the worst imaginable way to make money. When you're speculating, then you're no different from a gambler who stakes his money and bases his standard of value on market prices. Of course, once in a while you might be rewarded, but such wins are usually short-lived. However, if you want to be an intelligent investor, you should solely focus on long-term financial gains, reliability, and sustainability. By all means, do away with the temporary gratification of speculation and devote time to only investing in a stock that you have calculated its worth based on the value of its business. As an intelligent investor, you should follow these 3 principles. Understand the long-term business fundamentals of a company before investing. Don't get moved by the short-term price swings. Protect your capital by diversifying. investing in multiple stocks, allocating your funds, and setting a limit on how much you can invest in a single company. Understand that you won't get rich quickly and avoid such traps. Look for steady, long-term gains instead of quick money making. Do you think Graham's investment advice is still applicable in today's market? Share your thoughts in the comments. Also, if you want me to summarize any book on finance, let me know that in the comments as well. To see more similar videos, kindly subscribe and like. Thank you.